Welcome to Bank Director's online training series and the unit on the Consumer Financial Protection Bureau. My name is Brian Lane, and I'm a partner at Baker Tilly, a full-service accounting and advisory firm. There is no bank in the United States, or indeed any company, that sells some form of financial product to consumers, regardless whether it's a bank or not, that has not felt the impact of the Consumer Financial Protection Bureau. Although it's only been in existence since July 2011, the CFPB has already become one of the financial service industry's most powerful regulators. For banks and non-banks that sell financial products to individual consumers, the presence of a strong regulatory advocate for consumers is a true game changer. In this video, we'll provide you with an overview of the Bureau, including its broad authority and expansive scope of operations. And we'll offer some practical suggestions based on a significant number of experiences that our clients have had with the Bureau for how your bank should approach this brave new world of consumer compliance. The CFPB was created by the Dodd-Frank Act of 2010, which was passed by the United States Congress a few years after the financial crisis. It was a direct response to some very serious marketplace abuses that occurred during the home mortgage lending boom that preceded and precipitated the crisis. The original idea was to have a body similar to that for consumer tangible products, in this case, the Consumer Product Safety Commission. The CFPB represents a historic change in how personal financial products sold by banks and non-banks are regulated. Previously, consumer compliance in the banking sector was the responsibility of three prudential regulators: the Federal Deposit Insurance Corporation, the Federal Reserve, and the Office of the Comptroller of the Currency. However, these agencies have traditionally focused more on safety and soundness issues, and it was the opinion of many in Congress that consumer compliance was a much lower priority for them. Also, many of the marketplace abuses that we saw prior to the financial crisis occurred outside of the banking system. Non-bank companies that sold personal financial products were largely unregulated when it came to consumer compliance. 4+ years after the Bureau's creation, we think it's fair to say the financial service industry is still coming to terms with this new reality. Let's take a few minutes to review the Bureau's statutory authority under the Dodd-Frank Act and how it also operates, because it will help you understand the power behind its broad mandate to police the personal financial market. The Bureau operates within the Federal Reserve as an independent regulator with its own budget that's not included in the normal congressional appropriation process. It has a single director, Richard Cordray, who oversees the agency's operations and policy deliberations. Unlike the FDIC or Securities Exchange Commission, the CFPB does not have a bipartisan board of directors appointed by the president to ensure a sense of political balance in its policy decisions. The director's appointment must be confirmed by the Senate, and the director is required to testify before both houses of Congress twice a year. But in actual practice, Congress has very little direct control over the Bureau. It's truly an independent agency, virtually free of congressional oversight. This has been a sore point for many congressional Republicans, not to mention the financial service industry's various trade associations, since the CFPB's inception. While the Republican Party currently controls both houses of Congress, it does not seem to have sufficient strength in numbers to overcome strong support for the Bureau from most congressional Democrats or to override the veto of a Democratic president who strongly supported its creation. I think it is probably true that most bankers, and especially community bankers, are angered by this increase in their regulatory burden. Many of you believe that banks have been punished for the sins of non-bank financial companies during the mortgage lending boom. However, it's important to remember that large financial institutions are generally not seen in a positive light in the United States, and the public is probably more supportive of the Bureau's cause than our own. Although the political situation could change in the future, this is the reality of the situation as it stands today. The CFPB is a powerful regulator which operates with a great deal of autonomy and sees itself as an advocate for the consumer. The Bureau also has a very broad mandate to regulate the consumer financial market, with the authority to both set the rules and enforce compliance with those rules. When Congress created the CFPB, it took a number of existing consumer protection statutes that had belonged to other federal regulatory agencies and transferred rulemaking authority to the Bureau. Included in this transfer of authority were the Truth in Lending Act, the Real Estate Settlement Act, and the Home Mortgage Disclosure Act. The CFPB has broad authority to rewrite the rules under these and other consumer protection statutes, as it did in 2013 when it made a number of amendments to the Truth in Lending Act that have had a significant impact on the home mortgage market. In addition to banks, the CFPB is responsible for consumer compliance at non-bank mortgage companies, payday lenders, debt collectors, and student lenders, and recently announced it would also start focusing on non-bank auto lenders. Although the Bureau has the authority to directly examine any bank or non-bank company selling financial products to consumers for compliance, it currently focuses its examination efforts on those depository institutions that are $10 billion in assets or larger. The FDIC, Federal Reserve, and OCC are still responsible for enforcing compliance with consumer protection laws for institutions under the $10 billion threshold. Since the CFPB's inception, we've seen an increase in the level of cooperation between it and the prudential regulators, and there seems to be little opportunity for smaller institutions to play the game of regulatory arbitrage. Because it has the authority to modify existing consumer compliance rules and create new ones, the Bureau still drives the consumer compliance agenda for all banks, regardless of their size. The Bureau also has the authority to levy fines against companies for violations of consumer protection laws. For example, in 2015 alone, it hit Citibank with $35 million civil money penalty and required it to provide $700 million in relief to consumers that it found were harmed by illegal practices related to credit card add-on products and services. Working with the FDIC and the OCC, the Bureau also fined Citizen Bank $20.5 million for failing to credit the full amount of deposited funds to some of its customers' accounts, and also required Citizens to refund $11 million. In another example, the CFPB fined Regions Bank $7.5 million for charging overdraft fees to consumers who had not opted in for overdraft protection, and it also forced the bank to refund $49 million in fees. We're sometimes asked by directors and senior bank executives, how do we stay in compliance? The regulations are complex and the CFPB's legal authority is absolute. The answer is you have to start by focusing on the consumer. Are you absolutely certain that any adverse action you take against a specific retail customer of your bank would pass muster with a regulatory agency that is biased toward consumer protection? There are actually two tests that you have to meet if your bank is contemplating taking adverse action against a consumer. The first is the substance test. Are the possible actions in compliance with the law? The second test has to do with appearances. Are the actions going to stand up in the court of public opinion? After the collapse of housing prices during the financial crisis, when home foreclosure rates skyrocketed, many banks were criticized for sending out foreclosure notices with mechanically produced signatures, a practice that's sometimes called robo-signing. This happens with documents every day in the business world. But when a mechanical signature is used to start a life-changing event, like a home foreclosure, the financial institution will lose in the court of public opinion every time. We recommend that organizations deal with the CFPB as they would their largest, most problematic customer. How would your CEO react if the bank's largest client called and said they were upset with one of your products or services? Either he or another senior executive would probably hop on a plane the next day and visit the client to start the remediation process. This process would include a formal remediation plan where the bank and the unhappy customer would agree on all the remedial steps that needed to be taken, with a timeline spelling out when they would be accomplished. You would also want to resolve the issues as quickly as possible, with an emphasis on taking quick and decisive action so you are able to show that demonstrable progress had been made. And you'd want to have frequent touch points with the client so they know that their concerns were being addressed. We would also advise that you adopt the same best practice for developing a constructive relationship with the CFPB that you would for any other regulator. There should be a contact person high up in the organization that has the responsibility of maintaining a regular dialogue with the Bureau and, in effect, owns that relationship. Our firm has worked with clients that ran into difficulty with the CFPB, and the CEO or president dropped what they were doing and met with the agency's personnel in a very proactive effort to get all the issues on the table and solve them as quickly as possible. We've also seen situations where it took a long time to get the CEO to the table with the CFPB to resolve a consumer compliance issue, and those did not work out so well for the bank. We have seen a variety of bank responses to contact with the Bureau over a compliance issue. Senior management and the board have at times resorted to denial and argued that the bank had done nothing wrong and was being singled out by the regulator. Others have perceived the compliance issue as purely a legal issue with no appreciation for the optics of their actions. And some management teams and boards simply want to fight, which is a natural instinct when they feel their bank is under attack. However, I would advise you to never allow your dealings with the Bureau to become adversarial in nature. This is a battle you will probably not be able to win. I can certainly understand the pride that people have in their organizations and the fact they are doing things correctly. But it's like a football team that's playing an away game. You're not going to get the calls from the officials, in this case the CFPB. And the crowd, which in this analogy is the general public, is also going to be against you. You can't use the same game plan for an away game as you would for a home game. That's the reality of where we are right now with the CFPB. Let me suggest a few things you might want to incorporate into your bank's consumer compliance program. We advise banks to appoint someone within the organization to act as an internal consumer advocate. The role of this advocate would be to look at transactions, processes, and controls to evaluate how the bank is treating consumers and how that behavior might be viewed by the general public. Having a function or capability inside the organization that looks at products and processes from the perspective of the consumer can be a useful preemptive compliance strategy. You don't necessarily have to hire someone from the outside to act as the bank's internal consumer advocate and drive your costs up even higher. The bank's internal auditing or compliance teams could add this advocacy role to their existing duties. It's also important that the staff in your bank be empowered to raise consumer compliance issues when they come across them. Too many organizations continue to shoot the messenger when potential compliance violations are brought to the attention of senior management, and this can only work to your disadvantage. Unfortunately, many banks end up with significant compliance violations that were known at lower levels of the organization, but the culture did not allow them to be surfaced. Discovering potential compliance problems before they come to the attention of the CFPB is important for another reason. I have worked on several large settlements with the Bureau and other regulators, and I can tell you from firsthand experience, it's always better when an organization finds a violation on its own and brings that to the attention of the regulators, along with a corrective action plan that's already been initiated. That is always a better situation than when an examiner discovers the violation first. Self-reporting and prompt corrective action can only occur when the organization is doing a thorough and honest job of monitoring its own compliance. I would also suggest that every bank take a hard look at the products and services that it offers to consumers, because all of these have to be managed from a compliance standpoint. This is especially important for community banks. I see a lot of smaller institutions trying to match the product lineups of the bigger banks pound for pound, with all the same features and level of complexity. Can your bank support all of its consumer products long-term in a way that will allow it to meet its profitability targets and still stay in compliance with all of these new rules? There's a big need in the marketplace for straightforward products that consumers can understand, and these products are also easier for the bank to stay in compliance with. You should also make sure your bank is making use of the many technology tools and databases that will help you manage the life cycle of regulation from a compliance standpoint. Staying on top of the large volume of consumer regulations that exist, many of which are changing even as new ones are being added, is extremely important in this new era of heightened consumer advocacy. Technology can help by tracking and reporting all this information for you automatically. And I would encourage every bank to pay close attention to the information coming out of the CFPB itself. The Bureau was criticized early in its operation for not providing the financial service industry with regulatory guidance in the same way that the prudential banking regulators do on a routine basis. Instead, the CFPB seemed to rely more on the use of formal enforcement actions to show where the compliance boundaries lay. However, there's actually a lot of useful information that is available on the CFPB website, including an online report called Supervisory Highlights that is published several times a year by the Bureau. There is also a number of independent websites that also follow the CFPB and will help keep you informed on rule changes and supervisory developments. It's especially important to note those developments that cut across multiple industries, like debt collection. There are, of course, many firms that specialize in debt collection, but many banks also perform this activity for themselves. And just because it isn't labeled banking doesn't mean that it isn't highly relevant. Let's review by summarizing a few key takeaways. The CFPB was created by the Dodd-Frank Act of 2010 and represents a historic change in how personal financial products sold by banks and non-banks are regulated. The Bureau operates within the Federal Reserve as an independent regulator with its own budget and operates free of direct congressional oversight. The CFPB has a very broad mandate to regulate the consumer financial market, with the authority to both set the rules and enforce compliance with those rules. The Bureau has examination authority for banks with $10 billion in assets and above, while the FDIC, Federal Reserve, and OCC has examination and enforcement authority for institutions with less than $10 billion. The Bureau also has the authority to levy fines against banks for violations of consumer protection laws, and a number of its fines have been for tens of millions of dollars. Any consumer compliance program should start by focusing on the bank's customers. Are you absolutely certain that your actions and behavior would pass muster with a regulatory agency that is biased towards consumer protection? There are actually two tests that you have to meet if your bank is contemplating taking adverse action against a consumer. The first is the substance test. Is the possible action in compliance with the law? The second test has to do with appearances. How is the action going to stand up in the court of public opinion? We recommend that organizations deal with the CFPB as they would their largest, most problematic customer. When a potential violation has been identified, it should be remedied as quickly and proactively as possible, with frequent communication at a very high level between the bank and the Bureau. We also advise that you adopt the same best practice for developing a constructive relationship with the CFPB that you would for any other regulator. There should be a contact person high up in the bank that owns that relationship. We have seen a variety of bank responses to contact with the Bureau over a compliance issue, ranging from denial to viewing it primarily as a technical legal issue. The greatest mistake, however, is to allow your dealings with the Bureau to become adversarial in nature. Fighting the CFPB is a battle you will probably not be able to win. We advise banks to appoint someone within the organization to act as an internal consumer advocate. Having a function or capability inside the organization that looks at products and processes from the perspective of the consumer can be a useful preemptive compliance strategy. And it is key that the staff in your bank be empowered to raise consumer compliance issues when they come across them. And lastly, every bank should take a hard look at the products and services that it offers to consumers, because all of these have to be managed from a compliance standpoint. There's a big need in the marketplace for straightforward products that consumers can understand, and these products are also easier for the bank to stay in compliance with. Thank you for joining me for this training video on the Consumer Financial Protection Bureau.